Fed's going to be meeting this week with pressure mounting, of course, from the president to lower interest rates. Joining us right now, former federal vice chair Roger Ferguson. He's also a CNBC contributor. Good morning to you on this Monday morning, Roger. I don't think anybody expects Jay Powell to lower interest rates. I don't know if you have a different view or you think something else is going to come, not just this week, but what we're going to see in the rest of the year.
So certainly I agree with you. Almost impossible to imagine a cut in rates this week. A lot of data to come in, and I would say the market needs to understand, is looking to see when that September is in play. I actually doubt that September is going to be the time for them to cut either. So far the economy has held up very well. At the recent visit that the president paid to the Fed, he was talking about how strong the economy is. The most recent labor report suggested a pretty good economy, and markets are doing very well. So I don't think things are set up right now for either a move in July or September at this stage. We'll wait and see what the data show us, but I think the market may be a little disappointed in pricing a September move.
Question about sort of Fed independence, optics, and the like. Given the consistent pressure on the Fed, given even the sort of theatrics we saw last week, which I'd love to get your thoughts about just as you were watching that, what you were thinking. But do you think that unto itself puts actually more pressure on the Fed not to lower interest rates?
Andrew, I hope that's not true. I mean, they really should be looking only at the data and deciding what the data tell them. However, to be clear, people are only human beings, so to speak. And I suspect for a few of them, the pressure is likely to backfire. But I really think society, the president, and the Fed itself should be looking at the fundamental data. Sadly, to your point, everything's now become much more politicized. I think that's unfortunate because it takes the attention away from the real question, which is what is the right move for the economy given the Fed's mandate.
What were you thinking as the president took that piece of paper out of his suit pocket and Jay Powell put on his readers to look at it?
First, you used the word theatrical. I would say that was true. Everyone saw then, Chairman Powell taking a look at the numbers and correcting the president, which rarely happens in public. So it's good to see our Fed chairs numerate, even under that kind of pressure. And finally, and most importantly, it's just part of a pressure campaign. Often that happens in private. To have it happen in public, I think, is really, risking a lot of credibility for the president himself and, in fact, for the Fed, depending on how they act.
Roger, we're going to get jobs numbers later this week as well, which I think may impact, or you'd imagine would impact not, of course, this week's view of interest rates, but potentially later. There's been a divergence in terms of private payrolls coming out of ADP, which we will get on Wednesday, and then what we keep hearing from the Labor Department, though, of course, the Labor Department keeps revising its numbers down. What do you make of that divergence? Do you think we should be reading anything into it?
I don't think we should read that much into it. It goes on for a period of time. The numbers that matter most are what the government puts out. I think there's some adjustments, for example, number of businesses that come and go, which is really hard for ADP to understand in short term. So right now, I think, let's let the ADP numbers play out, but let's really focus in on the official numbers because that's what's going to drive the Fed's thinking.
And then the other piece, of course, are tariffs. We got this new deal coming out of Europe. Of course, it's just a framework. I don't know if we'll actually see it in practice for some time. We still don't have China. Obviously, you have this August 1st deadline with so many other countries. I don't know if you think that gets pushed. But again, this Fed has said that it wants to be data dependent. To the extent that you believe that we will see higher prices, if you believe that at all, when do you think we would see that?
That's a really good question, Andrew, because people were expecting it earlier. I think the analysis suggests that part of what's holding this up is the fact that so much inventory is put in place, because of the early talk of tariffs. There's also the question that Becky was talking about of how businesses may respond to it. So I think we'll definitely get a better sense towards the second half. By definition, get a better sense towards the second half of the year. And it may actually be, in the fourth quarter. So I think the Fed is going to reiterate the statements made many times about uncertainty because everything has just been pushed off a little bit. However, I think at some point we definitely have to see at least a one-time impact in prices, and then there's a big question of whether or not that leads to an inflationary spiral. Let's hope not, but I think it's very much in focus for the rest of this year.
It's in focus, but which way do you bet on that? Do you think of it, I mean, the way Scott Bessent's talked about it, he accepts there may be a one-time step up, but he thinks it's a one-time scenario, not a all-the-time scenario.
I lean a little bit more towards the potential for inflationary pressures. We're coming off of a period that is highly unusual for almost all Americans, which is we actually had, very high inflation. Even now, the inflation numbers are coming down, but they still are closer to 2.5, 2.7, 2.9 than they are to the Fed's 2% target. And as individuals go into whatever their big box store is or order things on Amazon or whatever it may be, they're going to experience an increase in prices. That, I think, is going to lead to some loosening of inflation expectations, particularly if it comes at a point when the Fed is lowering rates. So I think they have to be very careful because the possibility of a bad cycle, I think, is maybe a little more present than the Secretary of the Treasury would like to admit.